Now, Italy will now have to ask the EU for an extension of the deadline to reprivatize the bank. Maddie?
Well, let's give you a look at how the Asian markets are faring this Monday to kick off the fresh trading week. And there is, the good news is there's more green than red, but we are still seeing some patches of negativity, particularly the Japanese market, which is lower by about 0.8%. We're also seeing Singapore and India lower. The greater China markets in the lunch break. We are watching Hong Kong closely. You can see a fairly flat performance there going into the lunch break. But of course, HSBC out in the lunch break with those numbers. The stock that's, of course, going into the lunch break higher by 0.5% in Hong Kong trade. So we'll be watching that at the reopen after the bank surprises with a 74% rise in Q3 profit and a $2 billion share buyback. And that wraps up this edition of Capital Connection. I'm Matthew Taylor in Singapore.
With me, Hadley Gamble, right here in Abu Dhabi. Squawk Box Europe coming up next. Stick with CNBC.
Very warm welcome, everybody. Welcome to this Monday edition of Squawk Box. HSBC beats with a 74% surge in third quarter profit as Europe's largest lender announces a $2 billion buyback program. The group's CFO, Ewan Stevenson, telling CNBC the bank is well positioned for any rise in interest rates.
It's 100 basis point parallel shift in the curve. It adds about $7 billion of revenue to us, or about 2 percentage points to our return on tangible equity. So we are very, very geared to a rising interest rate environment.
Talks between Unicredit and the Italian Treasury over the sale of Monte dei Paschi di Siena collapse, throwing doubt now over Rome's long-held commitment to privatise the troubled lender.
Shares in Evergrande's electric vehicle unit spike as the troubled conglomerate's chairman signals a shift away from property, despite work resuming on several of the developer's key projects. Facebook faces a raft of accusations as whistleblower leaks continue, ahead of further testimony today, clouding the outlook for earnings also due today.
So let's come back to that headline story. HSBC has posted a 74% year-on-year jump in third quarter pre-tax profit to $5.4 billion. That beat expectations. The London-based lender also announced up to $2 billion worth of share buybacks. Emily has more on the story and joins us now from Hong Kong. So a very respectable set of figures this morning, Emily, from HSBC. Just pull out some of the other details that the audience might be interested in.
Yeah, that's right, Jeff, and we are seeing a nice bounce in shares of HSBC on resumed trade. The Hong Kong market just back from the lunch break and seeing the HSBC shares up 1% in response to the Q3 report card, just showing you that the pre-tax profit up 75% to $5.4 billion. They were profitable across all regions in the third quarter, demonstrating what they said, continued earnings diversity. Asia contributed $3.3 billion to that, and over in the UK, HSBC reported pre-tax profit of $1.5 billion. Revenues of $12 billion, that's an increase of 1%. Net interest margins of 1.19%, that was stable compared with the third quarter of last year. Common Equity Tier 1 capital ratio of 15.9%, up 30 basis points from the second quarter. Now, the company says that they are confident, together with their strong capital position, enabling them to announce a share buyback of up to $2 billion, which they expect to commence shortly. And they didn't want to just sit on their hands with capital, so that's why they announced the share buyback plans. There was no dividend announced, though. The group will not pay a quarterly dividend during 2021, but will review whether to revert paying quarterly dividends at or ahead of its 2021 results announcement in February 2022. So Noel Quinn, Group CE, saying that they had a good third quarter performance with strong growth in profits supported by additional credit provision releases. We got a chance to speak to the Group CFO, Ewan Stevenson, just on the back of the earnings release. And of course, we talked to him about many things, including Evergrande and the potential rise in interest rates. This is what he had to say about a potential interest rate increase and the impact on the bank.
We've definitely seen over the last few quarters our net interest margin begin to stabilise after a pretty significant drop as a result of the impact of COVID last year. We are seeing volume growth now coming through. I think we're on track to deliver about 3% loan growth this year. For next year, we're guiding to mid-single digit loan growth. If we do see interest rates coming through, roughly if there was 100 basis point parallel shift in the curve, it adds about $7 billion of revenue to us, or about 2 percentage points to our return on tangible equity. So we are very, very geared to a rising interest rate environment. I think when you look globally, the rates that we're most sensitive to is here in the UK. Signs are that we will begin to see policy rate rises either late this year or early next, and Hong Kong, where I think we are beginning to see a trough now in the decline in interest rates, and hopefully as we get back into 2022, we'll begin to see a recovery.
And of course, the fallout over at Evergrande, or the potential fallout, while we're watching what's happening over there and the debt issues, we asked HSBC whether or not they had any exposure to Evergrande and what they were doing to limit any exposure. This is what he had to say.
We don't have any direct exposure to any of the red list Chinese property companies. We're reasonably conservative in our approach to lending to that sector, have been for some time. So overall, we are going through what the second order implications could be for the supply line. supply chain borrowers. But overall, I think we're very comfortable at this point with where we stand in relation to the Chinese real estate sector.
HSBC reporting the return on average tangible equity, or the ROTE, of 9.1%. That's an increase of 5.6 percentage points from the 9 months in the year-ago period. They remain committed to achieving a ROTE of greater than or equal to 10% over the medium term. So we are looking at HSBC shares continuing to gain traction in the Hong Kong trade, up 1.2% at 47.05, about 6 minutes into the afternoon session. Back to you guys.
That's terrific, Emily. Thank you so much for helping us out with the story. You've set us up neatly for Dickie Wong, then, Executive Director of Kingston Securities. Dickie, good morning to you. I mean, one of the reasons that they've been able to beat expectations by such a wide margin is they've released some of these provisions back into the accounts because clearly bad loans haven't been as bad as they'd anticipated from the pandemic. But is it a little premature for them to actually release these reserves, given that we still are battling this pandemic on both sides of the world?
Well, good afternoon, and thanks for having me. In terms of HSBC third quarter result, I will say the best is yet to come. If we take even a closer look to its earning result announcement, not only the reported profit, and also all rounded, you can see like HSBC can manage all region profitable. It's not something easy to achieve, especially when we talk about the pandemic is not yet over in every single country in Europe and also in North America. So in terms of their earnings outlook, it's quite positive. And moreover, this is not only given by the provision right back, but also I can see its top line and also its bottom line. And moreover, as we all know, like China and also Hong Kong market are quite important for the group. And I will expect the interest margin will improving in the next 2 or 3 quarters, especially when we talk about the local Hong Kong economy and also in their business in mainland China and etc. So all regions profitable. It's something that it's definitely better than most of the analysts' expectation. And also, one more round share buyback program also gives a big boost to its share price. But we have to bear in mind, in the past 1 month, HSBC share price actually outperformed the overall Hong Kong stock market. Also, given that most of the U.S. banks' third quarter result were better than expected, and including Wells Fargo and Bank of America and etc. So I would not expect HSBC share price will just like skyrocket in the past month, but it would definitely test the recent high at around $50 Hong Kong dollars maybe. But in terms of its earnings outlook, I actually am very confident about the fourth quarter result or the whole year result of the bank.
One of the issues, though, and it's our job here, Dickie, to look at this business and see if there are any areas of concern. And the investment banking income actually fell, which is not what we've seen in the US banks, and it's certainly not what we've necessarily seen in some of the other European banks that have reported through this period. Again, is that anything to be concerned about?
Well, actually, this is a very good question indeed. As we all know, for HSBC, they generate more than 70% of revenue from commercial bank, wealth management, and also retail banking. So investment banking arm for them also important, but not as important as when we talk about the other like retail and commercial banking, and also when we talk about the regional business, especially HSBC. Well, you can call them a World Bank, but most of the business earnings growth actually generated in the Greater China area. So this is actually the key earnings drive. But yes, you did make a very good point. What was HSBC able to catch up with other U.S. banks? This is another question.
Dickie, can I just come back to the very easy comparables? Looking at the numbers, it wasn't hard to beat this time a year ago, particularly when it comes to the European operations. But if you look across the board in all jurisdictions other than Asia, it seemed like the bar was so low. How long is that going to be a feature for HSBC?
Okay, in terms of the outlook, when we talk about its business in Europe and everywhere else, as we just mentioned, the group managed profitable in all regions in the third quarter. So if the trend can continue, I mean, in the fourth quarter and next year maybe, it will definitely give a brighter picture for the group as a whole. But yes, and when we talk about the interest margin and also what will be the next move for Federal Reserve, will they hike interest rate earlier than the market expected, or is it already? Will affect the overall interest margin for every single country's business? This is another question. So indeed, I'm confident about its earnings outlook, but honestly speaking, for like the policy, I mean, the dividend payout ratio in the next quarter, they may not be able to pay dividend, but for like next year, maybe they can go back to the original normal dividend payout policy. So this is another story. But honestly speaking, HSBC is one of the most beloved local banks in Hong Kong in the past, so it may gain more institutional and also individual investors' attention after this results announcement, I believe.
Dickie, one of the other big features of the earnings today was the company keeping a lid on expenses. It was up just 2% on the same time a year ago, some of that down to performance pay, also investing in technology, which we know is a huge feature for a lot of international banks at this point, but it managed to offset that with broader cost savings. Do you think the bank can continue to extract further cost savings, as no doubt the performance pay is going to be a feature for the bank, and no doubt the technology spend will remain a big feature as well?
Well, as for the third quarter, the reported operating expenses up 2%. And this is highly related to everything you have just mentioned, especially increase in investment in technology and everywhere else. So in terms of the operating expenses, it's a key factor that will affect their future earnings. So I believe that the bank will do everything they can do to control this expenses in the next quarter or two. But in longer term, the diminishing of the provision write-back may actually already diminish in the third quarter. So I would expect provision write-back will not be the key driver for the next 1 or 2 quarters. So yes, we have to take a very closer look at operating expenses in the future.
Dickie, thank you very much for joining us with your analysis.
Thank you very much.
Dickie Wong with us, Executive Director at Kingston Securities. Let's push on and tell you what else is also on the agenda today. Along with HSBC, we've got a slew of other European banks' results coming up this week. UBS is reporting tomorrow, followed by Deutsche Bank and Santander on Wednesday. Lloyds Bank and UniCredit take the stage Thursday. And to cap off a fairly big week on the earnings front for banks here, BNP Paribas, BBVA and NatWest all reporting on Friday. And there's more coming up next week, including Standard Chartered, Intesa Sanpaolo, Credit Suisse, SocGen and Commerzbank. So very heavy on the earnings front for the banks. Well, the Italian government has ended talks with UniCredit over the sale of Banca Monte dei Paschi after the two sides failed to reach a compromise on the valuation and capital injection required. The announcement marks a major setback in Italy's attempts to save one of the world's oldest lenders, ahead of a December 31st deadline to sell the alien bank set by the European Commission. Let's get out to Claudia for more from Milan. Claudia, this is a stunning turn in events for anyone who's watched this closely. And, you know, this is a company that turned over its last CEO, Jean-Pierre Mustier, because of a clash over strategy with the board effectively wanting to get this sale through to take over Monte dei Paschi di Siena. But now we've got a new CEO at UniCredit, and still, even though he's a deal maker, Orcel's not getting this one across the line.
Well, yeah, Karen, certainly it did come as a surprise that this deal did not go through. But if you actually look at the numbers and what the CEO of Unicredit was hoping to get, it does seem that, it makes sense that the government would not want to go forward with this. The Treasury did not agree to this request of 7 billion euro capital hike that Unicredit was making mandatory in order to move forward. The deal just was not going to work at those numbers. The Treasury, remember, was willing to put in about 2 to 2.5 billion. So we were really far away from anything that could actually bring this deal to a close. Now, the joint statement that did come out was a very short statement, saying that after hard work, despite the hard work to find a compromise by both sides, the acquisition has been interrupted. So at this point, it's not clear exactly what will happen next, but a likely option. Remember that the government was supposed to privatize Monte dei Paschi di Siena by the end of this year. They're going, of course, to go to the EU and get a longer time span to do that. So they are going, of course, to move forward on that front. And, at that point, the question is how will they move forward? The idea is that they may try to find a standalone solution. That is what some, market watchers seem to think may be likely. It is too early to tell, of course. But, the Unicredit deal, they were working so hard on it, and that was one of the things that the market was watching in terms of, what Andrea Orsel's mandate was going to look like. He did take on the helm of the Unicredit Bank this summer. So certainly this does mean, it is a strong message. But, again, remember that this week we will also be getting numbers out from Unicredit. It is expected that they will turn a profit for the quarter of 838 million euros. Of course, that's one of the reasons why this announcement was probably made yesterday, coming to the point in which they're going to be announcing their results. They needed to make some sort of a decision, make something official. As far as the full year is expected to go, they're expected to turn a profit there as well. 2.85 billion versus the loss of last year under the previous CEO of Jean-Pierre Moustier when they lost 2.7 the 8 billion. So this is, of course, a crucial time for Unicredit Bank, for all Italian banks. Unicredit is one of the first to report in this strong quarter in terms of GDP growth for Italy, at 6% growth, as we are moving out slowly but surely of the difficult situation that we were going through during the pandemic, as the economy starts to pick back up again. So we'll see, what they seem to think is going to be expected moving forward as well. But as far as MPS is concerned, a few last comments about that deal. Remember that, the crucial aspects were, of course, that injection by the state, as well as the employment issue. There was the need, of course, for Unicredit to not take on too many employees and not too many branches as well. But it looks as though those were key issues in the fact that the deal, in fact, in the end, did not close. So, big week in terms of, Treasury Ministry decisions, as well as for Unicredit. Karen?
Claudia, let me pick up. Thank you so much for that. Banco Sabadell has rejected an offer from the UK's Co-op Bank to buy the Spanish lender's British subsidiary, TSB. Earlier this month, Sky News had first reported the £1 billion takeover approach, despite Sabadell's board deciding against a sale last March, following early attempts to offload the business unit. Well, still to come on the programme. A wealth tax is on the table as Democrats work towards passing President Joe Biden's sweeping spending bill.
And for more on what to expect as earnings season ramps up on both sides of the Atlantic, you can check out the Squawk Box podcast.
Hey guys, you can see the oil market has been going up. We have a buy signal here. Gold has been going up. Even if we have a drop, like from 13, we have like 30-point drop, it's still a buy signal. So if you bought this drop, you're still making money. You should be long from here. And here is no signal, no signal. Euro yen, you should buy every dip. So if you keep buying euro yen, as long as we have a buy signal, you're doing okay. We don't have any signal here. We don't have any signal here. Dollar yen, it's a good sell since Friday. We have a sell signal so far. You can see all red all over the place. And we here, OCN, we have a buy signal. If you've been buying, you should be making money by now. New Zealand yen also, it's a buy, and it's making money. So we have pound Aussie, it's a sell. Every rally you sell, every rally you sell, and you've been doing so far. So when we have a green signal, it's a buy. You should buy every dip, and if we have a sell signal, you should sell every rally. And if we have a green and red, you don't do nothing. Like here, you don't do nothing, you don't do nothing. Here, you just buy. Here, you just doing sell. Here is buy signal, and buy signal. So I guess every signal looks great, and we're doing okay so far. Euro dollar, let me move this a little bit. We have a buy signal in euro dollar.
Welcome back, everybody. Democrats are, quote, pretty much there on a pared-down version of President Biden's social spending bill. So says House Majority Speaker Nancy Pelosi. The president held weekend talks with Senate Majority Leader Chuck Schumer and Joe Manchin, who is reportedly now on board with a wealth tax on billionaires and some companies in order to help pay for the bill after initially opposing the measure. Pelosi told CNN that 90% of the bill has been agreed amid lawmakers' hopes they can reach a deal by the end of the week. U.S. Treasury Secretary Janet Yellen now says inflation will likely stay high until the second half of next year, but that the U.S. is not losing control of price rises. She also claimed current supply chain issues will subside as pandemic pressures ease. Karen.
Jeff, let's take a look at that U.S. market action as we just eased off some of the records for the major markets like the SP 500, but the Dow still inking out a fresh record level as it closed up shop. So slightly mixed performance, but investors fixated on the earnings and also the inflation outlook, and the messaging very strong from a lot of companies last week that we are getting those pricing pressures, some passing on those increases to consumers who are prepared to pay the high prices at this stage. And that is a feature that investors are looking at, who has pricing power in this market. When it comes to the Dow, American Express, one of the big top performers for the index, that 0.2% bounce, very strong trade, third positive in a row out of 4 for the major markets is what we saw stateside. So very strong at that record level. The SP 500 also inking a fresh record intraday, just not holding on to it by the close, and you could see fading a 0.1%. The Nasdaq, bigger falls and lots of other features to contend with. Still bumpy old numbers. Don't forget, we're talking about Snap last week and how the company's been disrupted on the advertising front by changes from the Apple policy. This saw the stock slump 26% in session, a big mover to the downside. Big question is what happens now on technology earnings as we get set up for a very full week from the Silicon Valley report cards. So that'll have a huge bearing on the Nasdaq and potentially the S&P 500 this week. Let's take a look at the dollar. This is how we have been performing on the mix of currencies this morning. The dollar is on the back foot versus sterling and euro. Those currencies both supported versus the greenback. We are still seeing some strength versus the safe haven Japanese yen. So we've marched up by just over 0.1%, but flipped a fraction weaker versus the Chinese currency. And to commodity markets, this is how we are performing on WTI and Brent. Don't forget, we have been closely eyeing just how strong the trade has been still on the energy price and what that's meant for some of the big stocks in the basket. Big outperformance by the big energy names, which has also questioned the principles. A big, huge weighting away from this area of the market for some of the funds that are trying to follow those ESG goals, but they have missed out on a much better performance that you've seen from the energy stocks. And the spot prices just, as you can see, 84.5 on WTI, above 86 on Brent and gold this morning, picking up some action, closing the gap towards $1,800. The opening calls in Asia. Let's see how Asia has been travelling. You can see Japanese stocks down 0.8%. That is a weak start to the trading week, but we are performing across on the other markets. Modestly firmer is what we're watching. To the opening calls in Europe, we are looking like this. The market, don't forget, last week was stronger. In fact, the Stoxx Europe 600 has recaptured all of those September losses and bounced about 4% so far for the month of October. That's a strong indication. And what we've got on the boards also very positive, suggesting we'll bounce again for the start of trade Monday, adding to that near on 0.5% gain on the Stoxx Europe 600. And what we've got on futures stateside, we are also seeing a little bit more green flash up, indicating perhaps fresh records again for the Dow, and that the other major markets will also tilt firmer. We are within striking distance still for records for the S&P and NASDAQ. So we're close, and if you get a firmer session, you can see that you could ink some fresh records again on the street. Jeff.
Karen, thank you very much. Well, even the Queen's name has been invoked in connection with the French elections, but somehow I don't think she's on the ticket. France kicking off its 6-month countdown to the presidential election. Several candidates looking to replace President Emmanuel Macron. We will have more from Paris right after the break. We will leave you with a rather murky shot of the Seine at this hour. Stay tuned. We'll be right back. back to Squawk Box. HSBC beating with a 74% surge in third quarter profit as Europe's largest lender announces a $2 billion buyback. Group CFO Ewan Stevenson telling CNBC they're well positioned for any rise in interest rates.
There was a 100 basis point parallel shift in the curve. It adds about $7 billion of revenue to us, or about 2 percentage points to our return on tangible equity. So we are very, very geared to a rising interest rate environment.
Talks between Unicredit and the Italian Treasury over the sale of Monte dei Paschi di Siena collapse, throwing doubt over Rome's long-held commitment to privatise the troubled lender. Shares in Evergrande's electric vehicle unit spike as the troubled conglomerate's chairman signals a shift away from property despite work resuming on several of the developer's key projects. Facebook faces a raft of accusations as whistleblower leaks continue ahead of further testimony today, clouding the outlook for earnings, which are due after the bell. Well, the row between Poland and the European Commission is heating up. Poland's Prime Minister Mateusz Morawiecki accused the EU of making demands with a, quote, gun to our head, urging the Commission to stop making threats of legal and financial sanctions. In an interview with the FT, Morawiecki said he would not hesitate to retaliate if Brussels tried to withdraw funds, including the €36 billion COVID recovery package, amid a dispute over the rule of law. Meanwhile, France has started its six-month countdown to the presidential election, with several candidates vying to replace incumbent Emmanuel Macron. Charlotte joins us this morning from Paris. And Charlotte, I was only slightly tongue-in-cheek talking about the reference to the Queen being drawn into this election debate. But we've got a very colourful start to the election campaign, with shots of the Queen over an M80 assault rifle being used by one candidate.
Well, look, Jeff, in exactly 6 months, France will wake up with a new president at the Élysée Palace. It's just a few hundred meters behind us on the other side of the Seine River. Maybe it will be a rainy morning like today. But as you say, it's a very interesting campaign. There's a lot of stake. Can President Macron be re-elected? He hasn't announced yet that he's running again, but of course all expectations are that he will. So I'm pleased to say that I'm joined by Jean-Philippe Dubrul, who's Director of Research at the French Institute of Public Opinion, to set up the scene for us. Thanks for joining us. So tell us, President Macron is actually quite popular compared to some of his predecessors at this point of his mandate. What are his chances of re-election, and what are the key challenges for him in the next 6 months?
Yes, as you said, Emmanuel Macron has a strong supporter base right now, and for the last year, around 40% of the French declare themselves satisfied of him as President of the Republic. So this is a strong supporter base, of course, and much more than his predecessors, because during the term, at the same time, 6 months prior to the election, Nicolas Sarkozy had 9 points less in satisfaction, and François Hollande even 26 points less. So, of course, this is an advantage in anticipation to the next election. And right now, we can say that since his election, Emmanuel Macron has always been on top of the voting intention polls for the next election. And now he's around 25% of voting intentions, which is quite stable and strong.
So last time in the second round, Emmanuel Macron had to run against the far-right candidate, Marine Le Pen. Is it the most likely scenario this time around? We know there's a new figure on the scene as well. It's called Éric Zemmour, this TV commentator who has some very outrageous comments that come to appeal to some of those far-right voters. Is that a real challenge for her? We know the last local elections she had, her results were not too good. So what does that mean overall in the campaign?
Well, to date, the competition for the access to the second round of the presidential election has never been this uncertain. Because now we have 3 candidates: Marine Le Pen, Éric Zemmour, as you said, and Xavier Bertrand, the probable candidate of center-right, these three candidates are now tightly bunched together around, with a spread of 2 points in voting intention polls. So right now, we cannot say who among the three would access the second round to face Emmanuel Macron, even if Marine Le Pen has a slight advantage, very close to Éric Zemmour, the TV commentator that is now the candidate to be.
What would be the best scenario then for President Macron for out of these names to come into the second round to face?
Well, for Emmanuel Macron, a far-right opponent is the best, gives him the best chances to win the election. If he faces a center-right candidate in the second round, well, there is a credible alternate possibility in front of him, and in the voting intention polls that they carry on since several months, we see that Xavier Bertrand against Emmanuel Macron would either win or reach a tie against him. That is not the case if Emmanuel Macron faces a far-right candidate against which he would win by a large margin.
So you mentioned the center-right candidates. They actually haven't picked their candidate yet for the election. It could be Xavier Bertrand, who seems to be the front-runner. There are other names on the table, including Valérie Pécresse and also the Brexit negotiator, Michel Barnier. And it's said that within the members of his own party, he's actually quite popular. Could he be the dark horse of this race?
Yes, this is a very interesting question, because among the French in general, when you ask them about the best candidate for center-right in the next presidential election, Xavier Bertrand is the front-runner, of course. But among people in the party, Les Républicains, Michel Barnier seems to be more popular, and as pollsters, we have to be humble in front of this situation, because in the last primary election of center-right, François Fillon, which was only the third in voting intention polls, had won the investiture and ran for the presidency. So, as a pollster, again, I can't try to tell you the future, but yes, Michel Barnier has a chance to be the candidate for center-right in the next election.
In terms of topics that are central to this election, it seems like the question of energy, for example, we've seen the government giving some handouts. You know, there's the ghost of the Gilets jaunes that started with an energy crisis, really an energy price crisis, giving a bit of fear for them. So there's some handouts. The purchasing power, the question of inflation taking center stage. Is that going to be the key? Is it all about the economy? Is the economy stupid? Or is it, there's also a question of security, immigration, like what will be at the heart of the campaign?
Well, of course, the cost of energy has stormed in the debate in the very last days. But when we ask the French about the topics that will determine the vote in the next election, in first you have health. And that was a tendency prior to the COVID crisis. Then you have security and immigration. That explains why such a far-right candidate as Éric Zemmour has doubled his score in voting intention polls, because the context is very favorable to him. But purchasing power issues are now much less of a concern now than it was 5 years ago in the very beginning of the campaign.
Another question is abstention, because we know in the last election, which was a local election, abstention was very high. We know that presidential elections usually have a higher turnout, but there's still to be a sort of disinterest in politics, or people moving away from politics. How much of a risk is it in this campaign?
Well, as for now, comparing to 5 years ago, 6 months prior to the election, we do not measure now a sensible decrease in turnout intention. So, up to date, I cannot say that there will be less turnout and that this is a risk for the next election. Especially because Emmanuel Macron has been a very, popular president, but also he polarizes the opinion around him, and people who like him very much, and people who hate him, because hate is the term, is the right word. People who hate him very much. So even opponents to Emmanuel Macron's policy would be tempted to go to ballots because even if they don't believe in politics anymore, they would want to, pardon me the expression, kick out Emmanuel Macron of the Elysée.
What should be the key challenge for him to tackle? If he wants to be re-elected for the next 6 months, what should he focus on?
Well, the very first risk for him is the rise of a new yellow vest movement. So this explains why the executive has been this reactive to extinguish the fire of energy cost issues by giving, giving all people who needed it checks to pay for their electricity bills and gas bills.
Well, that's a lot to think about. As we know, 6 months in a presidential campaign is a long time in France in particular, so a lot of stake here. But thank you very much, Jean-Philippe Dubreuil, Director of Research at the French Institute of Public Opinion. And stay with us, we'll have more guests to bring you later on the show. Karen.
Charlotte, thank you very much, and terrific to see you kicking off the conversation on our French coverage already at this early stage. It's going to be incredibly interesting. Let's take a look at Turkey as the lira has slid to a record low against the dollar after President Erdogan declared the ambassadors of the United States and 9 other countries persona non grata. Erdogan has told his foreign ministry to expel the foreign envoys after they signed a joint letter calling for the release of imprisoned businessman Osman Kavala. But the president's political opponents say the move was to distract from Turkey's own economic problems, including the central bank's decision last week to cut policy rates despite rising inflation. And coming up on the show, we're going to talk about Facebook, which is facing more troubled accusations leveled in new document leaks. Take another look at these markets. Friday session saw fresh records for the Dow as it marched up to 35,677, 0.2% in the green. So fresh levels that we saw despite a mix of earnings where investors are having to wade through the detail on cost pressures, the big inflation fear that a lot of investors have had for most of this year, really coming into the earnings mix for a lot of corporates. But that said, we are still seeing some of them able to pass on those higher prices to consumers at this stage. So somewhat a protective factor there, and also comparables are still being somewhat easier as we take a look at the earnings this year versus the same time a year ago for many of these corporates. Where that starts to become the exception, technology, and we know that many of the big Silicon Valley names had a very strong trade last year, so they're coming up against those tougher comparables this year. And tech earnings very much on the ticket this week. You can see a little bit of caution coming into the Friday trade for some of those big FANG stocks. And don't forget Snap in session, that stock plunging 26% on fears around its advertising revenue thanks to privacy changes over at Apple. So that was one of the big negative features for that area of the markets. But when it comes to the overall trade, we did see a very strong trade for the week. 7-day winning streak with Snap for the S&P. It did ink a fresh record over the trade, but just not holding on to it. But we did see for many of these markets, first 3-week winning streak since July. So it was a fairly strong performance yet again over the course of the week. Let's take a look at Asia. The early signals have been positive, modestly so for Australia, China and also Hong Kong. Japanese stocks, the exception, peeling back, and you can see plunging about 192 points at this stage. That is a fairly decent move south of almost 0.7%. And the Asian markets, what we've got across there, actually here's the futures too. We are looking towards the early signals there. You can see indicating a slightly better trade for those European markets at this stage in terms of what we've got in contrast to the Friday trade elsewhere, which was choppy in the States. European markets were actually fairly firm right across the board and held on to those finishes. 7/10s up for the French market in particular. Asia down. This is how we trade across the day. It's modestly firm, as you can see, for many of these markets, and Japan just tracking a little bit weaker. Jeff.
Thanks very much. Shares in Evergrande new energy vehicle are sharply higher after the troubled group's chairman said they would aim to shift away from property to make EVs the primary business within 10 years. That's as the indebted developer announces work is resuming on more than 10 projects. Construction was halted as the developer, which has over $300 billion in liabilities, struggled to make interest payments. Foreign bondholders have received payment from the late September tranche, but the company still faces the expiry of several 30-day grace periods from deadlines earlier this month.
Tesla has withdrawn its new full self-driving car due to detected software issues a day after its release. Users complained of false collision warnings and other problems. The electric car maker says the rollback is temporary. According to CEO Elon Musk, the challenges were no surprise as it was impossible to test all hardware configurations before release. And pushing on to China's big tech giants, which are looking to develop their own chips amid the global supply crunch as Beijing looks to boost its capabilities in the sector. But the country is still a long way away from self-sufficiency. Let's get out to Arjun for more. Arjun, I do remember a conversation we had back when the trade wars were happening under President Trump, and you pointed out to us that China, trying to develop its own chips, it was in a sort of inferior position versus some of the technology elsewhere. How is that gap at this point? Has it been closed to any extent?
Well, one thing we have seen, Karen, at this point is Chinese companies are jumping more into the area of chip design. You've seen just last week Alibaba launch a new chip design for its servers. Baidu earlier this year making an AI chip as well. When you're seeing a number of companies happening there. But this is just on the design front at this point, and a lot of those design tools required still rely on foreign technology, and that's basically the story of where we're at right now in terms of China's own self-sufficiency. They're a long way because they still rely very heavily on foreign equipment, on foreign manufacturing processes, and a closer look at some of these chips tells us a bit more about that. If I just mentioned Alibaba's chip there, it's based on ARM architecture, of course, ARM, the UK-based company. It's based on a process called 5-nanometer technology, and I'll get into that a bit further as well in a moment. Baidu's AI chip earlier this year also based on 7-nanometer technology as well. Now, if we think about design. As I mentioned, the tool's very much reliant on foreign companies. But if you think about manufacturing these leading-edge chips, 7, 5, and even smaller nanometers, there's only really 3 companies in the world that can do that. Intel in the US, TSMC in Taiwan, and Samsung in South Korea. China does not have a chip maker able to produce these leading-edge chips on any kind of scale, and that's a big issue right now as well. And the other big challenge here is along the entire supply chain, the power is concentrated in the hands of a few foreign companies. Of course, a good example over in Europe is ASML, the only company in the world that can make the specific machine required for these leading-edge chips. China just doesn't have these firms along the supply chain. So yes, you're seeing a bit of progress around design, but it's still lagging in so many different areas, and that leads then to vulnerabilities for China at the time now in terms of chip crunch, but also in geopolitical tensions as well. We saw Huawei when the US introduced that rule saying that companies that were making chips for Huawei but using American equipment could not sell to Huawei without a license. Basically, Huawei was unable to obtain those key processors from its mobile phones that were being made by TSMC, and that effectively crippled its smartphone business around the world. And that is really now, as a lot of these Chinese firms continue to push in self-developing chips, these are really the big risks now, is if there are any flare-up in geopolitical tensions, they could be cut off from accessing any of those chips. Guys, back to you.
Arjun, thank you very much for that. And for more on your piece on China's push to develop chips, our viewers can check out the cnbc.com webpage for that detail. Facebook allegedly gives special treatment to right-wing news sites because it is, quote, scared of political backlash if it enforces policy without exemptions. That's according to internal communications obtained by the Wall Street Journal, which further accused the company of a, quote, concerted effort to paint black Americans in a negative way. This comes amid a number of new reports which show how users of the platform can be directed towards extremist and potentially radicalizing content. Well, Facebook will release its third quarter earnings after the bell. The company had said in previous reports that it expected revenue growth to slow. The social media giant is facing several headwinds, including intensifying congressional scrutiny after whistleblower Frances Haugen alleged the company is, quote, weakening democracy. Meanwhile, Facebook shares fell in Friday's session as its rival Snap said privacy changes on the iOS devices hurt its ability to target digital advertising. And there are a slew of US technology companies that will follow Facebook. First up will be Twitter, Alphabet and Microsoft, all releasing earnings tomorrow. For a detailed guide as to what to expect, Pro subscribers can head to our website, and that is cmc.com, of course. Just to delve a little further into these Facebook numbers, I mean, what a time frame to come to market. You've had the Snap issues. I think Facebook all along has been trying to navigate around what we're seeing as a looming threat. And don't forget, Apple came up with these changes to specifically target Facebook. And I think Facebook, as I mentioned the other day, has been trying to execute more on its platform, trying to drive users through a process where they complete a purchase through that website, so they still can get that turnover on the advertising dollar. But what type of advertising market are we looking at? What are we coming up to with higher inflation down the track? And are we starting to see any cooling? I think that's going to be a very key signal for the market, because at this stage, a lot of the bulls have been circling the stock.
Yeah, no, it's a challenging one from the macro perspective, isn't it? Because as these yields rise, you do wonder what impact it will have on investor appetite to own growth. And so that's the challenge. You've got Janet Yellen, who has acknowledged that we're going to have inflationary pressures for a little bit longer, I think, than the Fed had previously signaled, with transitory. I mean, if this runs right through to well into the second half of 2022, as she is suggesting at this stage, and those comments that she made over the weekend, then that means that I think a lot of investors need to recalibrate how they think about the central bank's reaction function. Is the Federal Reserve actually going to respond to supply chain challenges with interest rate hikes, or indeed just some tapering? We don't know. But obviously there's a big swathe of the market that's already beginning to reprice that, and you can see that in the yield curve. So it's almost as though we've got a sort of twin track perfect storm for these technology companies at the moment. As you point out, there's the Apple-related privacy adjustments to the iOS operating system, and then there's all these whistleblowers who are coming out. I'm not sure how much this is touching the sides for real users of Facebook, but obviously it's getting a lot of run, and it means that legislators are under increasing pressure to react here. So even as we see tightening concerns weigh, I think, around growth stocks, the technology companies themselves have to demonstrate that they still have good momentum on the earnings side going into next year.
Yeah, just want to come back to what we're likely to see on the subscriber front. Don't forget, there's been a huge amount of additions at the start of the pandemic. People were still switching on. What's happened from there? Have they still got the same level of subscribers being added to the platform? There's a concern that they just don't have the younger audience anymore. And it's always been a concern where you've seen them go towards other platforms. Instagram, of course, is one of the Facebook ones, but TikTok, Snap, they're still picking up more of those younger viewers. And back to these internal documents, well, the American publications have been poring over the devil in the detail of these huge release of internal documents. And it's the New York Times on this particular story has been looking at some of the concerns internally that teens have been just exiting the platform. They're saying, from the Facebook view, that this is the pipeline. So Facebook executives have big concern that they don't get the younger audience on board, then they lose the future pipeline. And of course, we're talking about future revenues here as well. So that's a big one, what that audience is doing at this stage.
And is a rebrand any good when it comes to encouraging those teens to stay, or a younger demographic? I don't know. It's a well-trodden path. Give yourself a slightly different name, try and come up with some slightly edgier pitches around the presentation of the product. But I mean, it's still Facebook, isn't it, at the end of the day?
There was the other strategy. You use your huge cash reserves to buy something. But at this point, we know there are regulatory concerns about market dominance. So that obvious strategy would perhaps not be available to Facebook at this stage to try and protect its moat.
And just to remind the audience, I mean, if you're in an S&P tracker here, big tech is 30% of that index. So if we have some trip up on these earnings presentations this week at all, then that'll take some of the heat out of the recent run we've seen for the S&P.
Indeed. So it's a huge week on the tech front. But we're going to talk more about earnings, and coming up on the show, HSBC posts a strong third quarter profit and announces a sizable share buyback. We'll have more details on that after the break.
Welcome, everybody. This is the second hour of Squawk Box. HSBC shares in Hong Kong hitting a 4-month high after Europe's largest lender announced a beat in third quarter earnings, which surged 74%. Group CFO Ewan Stevenson telling CNBC they're well positioned for interest rate rises.
There was 100 basis point parallel shift in the curve. It adds about $7 billion of revenue to us, or about 2 percentage points to our return on tangible equity. So we are very, very geared to a rising interest rate environment.
Talks between UniCredit and the Italian Treasury over the sale of Monte dei Paschi di Siena collapse, throwing doubt over Rome's long-held commitment to privatise the troubled lender.
Shares in Evergrande's electric vehicle unit spike as the troubled conglomerate's chairman signals a shift away from property, despite work resuming on several of the developer's key projects. And Facebook faces a raft of accusations as whistleblower leaks continue ahead of further testimony today, clouding the outlook for earnings due after the bell.
HSBC has put in a 74% year-on-year jump in third quarter pre-tax profit to $5.4 billion. That beat expectations. The lender also announced up to $2 billion worth of share buybacks. Emily has the report.
HSBC reports a 75% increase in Q3 pre-tax profit to $5.4 billion. The increase driven by a release of expected credit losses and credit impairment charges. All regions profitable in the quarter on continued earnings diversity. Asia contributed $3.3 billion before tax. Europe at $1.1 billion. Revenue coming in at $12 billion, an increase of 1% on year. The bank called it a good report card with confidence together with a strong capital position, announcing a share buyback of up to $2 billion, which they expect to commence shortly. The banking giant will not pay quarterly dividends in 2021, but will review whether to revert to paying them at or ahead of the 2021 results announcement in February. Ewan Stevenson, HSBC Group CFO, told CNBC that the bank did not want to sit on excess capital and hence the share buyback plans. This is what he had to say with regard to central bank moves.
There was 100 basis point parallel shift in the curve. It adds about $7 billion of revenue to us, or about 2 percentage points to our return on tangible equity. So we are very, very geared to a rising interest rate environment.
I also asked about the big elephant in the room, Evergrande, and whether the fallout at the property developer had any material impact. Ewan said that HSBC does not have any direct exposure to any, quote, red list Chinese property companies and are reasonably conservative in lending to the sector. I'm Emily Tan in Hong Kong. Back to you.
Thanks so much, Emily. So an interesting set of numbers, and we came through some of the detail with Dickie Wong in the first hour, but I think it's just worth revisiting some of these themes for the audience tuning in at this point. And it seems to me the key question you've got to ask yourself with HSBC at the moment and with Standard Chartered, is Asia a driver of profitability or is it a brake? At the moment, is it holding back the opportunity for these banks to make higher profits? And it feels to me like the market's already made up its own mind on this, given that if you look at the performance on the year, HSBC, okay, we're up 15% here. Standard Chartered only up 5%. Barclays up 35%. Citi has made 16%. We know the other American banks have also done very well through this period. I think the investor base is clearly looking at some of the challenges around the greatest market, China, and of course Asia more broadly, where this bank has exposure.
Yeah, there are a lot of anomalies in this report card, which makes it hard to see into the future, and the fact that you had such easy comparables was a real standout for me. I mean, the numbers were woeful from last year in Europe in particular. So getting to a much higher return this year, as we're clear of some of the worst of the COVID pandemic, was certainly easier on the numbers and easier on the eyes of the report card crossed. And that was the same for a lot of the various regions for the business, except for Asia. The other big point here too, I mean, technology is coming to the mix in a huge way at this business, as it is in a lot of other banks. banks that have been investing in the technology, and the company's been talking about digitizing at scale. That's not just a subtle feature. It can drive efficiencies and profitability. It's not just a change you see on how you interface with the bank, but it does have consequences too for the bottom line. So that'll be fascinating to see how that is rolled out. And when we think about Asia, Asia's fairly fast in adoption of technology as well. So for the Asian customer base, what that means I think will be quite interesting going forward. But you do point out the interest rate scenario, and NIMs were down as a result of very depressed rates from Asia to Europe. And if we think about a lot of these emerging markets, the real sizzle in the numbers for the likes of an HSB, Santander, those that stretched across other emerging markets, was that they always had higher NIMs because they had better interest rates than some of the EM countries. But through the broader lens of the macroeconomic backdrop we've been talking about, EM has been particularly challenging because most of these EM countries have not had a great COVID crisis. So will the interest rate story be as strong for some of these big international banks like it has been in the past?
Yeah, and the COVID story hasn't gone away in China. The authorities talking again over the weekend about 100 new cases, I think, across 11 provinces. And they think they've identified them to 13 tour parties. But the fact that they still are having these little mini spikes in cases is important. But more important, I think, is the way that they respond to them with these broad geographical lockdowns and suppression of activity. And it's sort of very different from now this whole idea that we have here in the UK and I think in Europe that you're going to have to live alongside this thing for a long time. It is not going away. It is going to be like the flu. You just have to take a jab or treat it as it emerges, and hopefully its virulence will dissipate. But I wanted to make a slightly different point, I think, about HSBC and the opportunity set here in the UK, because they are still a very strong presence in the UK market. And some of that digitization that you're talking about, maybe Asia's already there. Hong Kong, I know, has been decades ahead of what's been going on in the UK in terms of digitization and customer expectations. But finally, I think HSBC, you really see it with their digital app and some of their other banking offerings, that now they're able to address the cost base as they have been over recent years around branch networks, and really encourage the UK customer to go to a primarily digital offering. And as for the NIMs, I mean, did you see Ewan Stevenson's response when Emily and Matt were asking about, how is the bank placed for any shift in the interest rate environment? I think he could barely keep the smile off his face, because as we know, all of the banks would love to see an improvement in the NIM environment in Europe. Whether that comes sooner rather than later, we're still speculating on, but obviously the Bank of England has been making positive noises around interest rate rises. Whether they deliver at this point, we'll have to wait and see. But you already see in the money markets, there is a shift to price in that expectation. So that'll be good news for them.
Yeah, I've got to say, as a customer, you get sick of throwing away those little documents saying there's been a change to the interest rate environment or regime, and it effectively means your savings rate's gone down. You sort of rip those ones up and put it in the bin out of distress of looking at the 0.00 almost that you're getting. But for the banks, any change here on the mortgage side, I wonder what impact it has. And there was a great article in the weekend in the FT talking about the UK insurer, Rothsay, that's looking to offer actual proper fixed rate mortgages in the UK, talking about 25-year term covering the lifespan of the mortgage, where you have the uncertainty effectively taken out of the equation. That could upend the mortgage market if enough people are scared about inflation. I wonder what an HSBC does in response to that, being such a huge player in the mortgage market here. No doubt there'll be rearrangement fees on a lot of the mortgages anyway, with people concerned around higher inflation and higher rates. Which benefits the numbers.
Let me say something about whether this is a positive development for the banks in the UK. I think the banks have done extremely well from the fact that we have what is perceived to be a competitive mortgage market, but I think hasn't been. The banks are clustered around the rates and the offerings, both on the fixed rates, which are nothing like 20, 25 years generally. You're lucky if you get 2 to 5, right? So they've been very happy to offer, floating rate mortgages effectively which have given them a lot of flexibility, but have also come, I think, at the expense of just a little bit more premium than you would see maybe in France or Germany or in the United States. If we went to something like a 20-year mortgage at 1.3%, which is, I think, what you can get in France these days if you're looking to buy a house, I think that would be fascinating, the impact it would have on the UK property market. I suspect that we'd be, you know, heating up again for another property boom, because we know that you can't get those kind of terms at the moment in the UK. You are very much put at the mercy of the market here, the money market, and if the rates go up, you take it on the chin. So if you could lock in 20 to 25 years at a little over 1%, boy, I think people would bite your hand off.
Exactly, you crunch the numbers on that one, but you know, this has been a feature of the Australian mortgage market forever. As long as I can recall, there was always very long fixes. When I first arrived back in the UK more than a decade ago, I was like, where are those fixed rate mortgages? I mean, you can obviously work out, most consumers I think can work out rates are going to go for the next 2 years. Not going to move that aggressively, are they, when we're in this low interest rate environment? But you want to fix that part? It's the bit down the road that most of us can't call. I mean, could either of us, despite being very close to markets, call what's going to happen on interest rates in 10 years' time? I don't think we could, right? 10 to 15. We don't know what's going to happen that time frame. How would the average consumer have a chance at that?
Well, and I think that's part of the problem, isn't it? That there are forces that take advantage of the ignorance of the customer here. I mean, you know, if you were to tell many of these mortgage holders what exactly the bank was able to raise to get that money at in the wholesale money markets, they'd be astonished. And they'd be thinking, why am I paying as high an interest rate as I am at this point? And there are lots of kind of anomalous situations like that in the UK. I think like the student loan scheme. I mean, why are you paying such high interest rates when the government can borrow at negative rates or near zero? It's crazy, and yet somehow it happens.
British are very good at extracting a fee on some of these financial services. Let's take a look at what we have got across the board in terms of the banks over the next couple of weeks. In addition to HSBC, we've got a slew of other European bank results coming up this week. UBS is reporting tomorrow, followed by Deutsche Bank and Santander on Wednesday. Lloyds Bank and UniCredit take the stage Thursday. And to cap off the big earnings week, BNP and BBVA, NatWest all reporting Friday. And there's more next week, including Standard Chartered, Intesa Sanpaolo, Credit Suisse, SocGen and Commerzbank. Of course, you can pick out your favourites based on the news flow. I'm sure Credit Suisse will be interesting, given some of the issues that they've had around risk. And of course, UniCredit with the latest around this particular story. The Italian government has ended talks with UniCredit over the sale of Banca Monte dei Paschi after the two sides failed to reach a compromise on the valuation and capital injection required. The announcement marks a major setback in Italy's attempts to save one of the world's oldest lenders ahead of a 31st of December deadline to sell the ailing bank set by the European Commission. Well, let's get out to Claudia for more from Milan. Claudia, just walk us through the stumbling blocks here. Do you think this is just part of the negotiations where one party walks off but is set to return to the table down the track?
I mean, Karen, I think it's pretty unlikely that that be the case at this point. I mean, that is, you know, obviously the question that everyone is asking themselves. But it looks like this is probably a dead end for a deal with, you know, between UniCredit and Monte dei Paschi. They had been working really hard on this. You know, it's almost a 3-month you know, time span that has been put, you know, that hard work has been put into. So the fact that it did not go through looks as though really there is no coming back from that. So Andrea Orcel, who took the helm of UniCredit this summer, you remember that at the end of July decided to go ahead and try and make this deal work. And the stock since then has actually outperformed. So, you know, the market seemed to be approving of that going through. But of course, you know, both sides were not really willing to give in completely. The key points that had been put in by Orcel regarded, you know, the positive impact on revenues for UniCredit, no acquisition cost. They wanted a limited perimeter in terms of assets, and of course there was the layoff issues. They wanted, of course, to lay off more people than, you know, what the government was willing to give them a go-ahead for. And then, of course, there are the legal risks, you know, going forward that they wanted to be free of completely. Daniele Franco from the Treasury did, though, you know, a month into these talks say this deal is not going to go forward at all costs. It looks as though Unicredit was maybe hoping to really, close this deal because the government needed to go forward with it at a really great number for them, and it just did not work out that way. The capital hike that the bank was requesting was around $7 billion. Remember that the Treasury was looking, as far as standalone was concerned, more around $2 to $2.5 billion. So really hard to close that gap there. So what will happen going forward at this point? First of all, we'll see how the market reacts to this decision in terms of how this is going to move the stock for Unicredit. They will be reporting this week their third quarter numbers that consensus has them coming in at about 838 million euros in profit. That's up from last year. They do expect also full year numbers to come in at a 2.85 billion profit as well. So strong numbers expected to come in there from Unicredit. But as far as the Treasury is concerned with the Monte dei Paschi deal, they are probably working on an extension that could go anywhere between 6 months to a year's time in order to work on their plan B. Will that be a standalone solution? It could be, it could involve, of course, changes in terms of management as well. They'll have to negotiate with Brussels and see what it is that they are willing to do in terms of trying to avoid a complete breakdown of Monte dei Paschi di Siena. So there's still a lot more to be understood and to be said, but certainly this does mark a strong decision by Orcel that, of course, everyone is really watching closely as he did take on this new role at the head of Unicredit just 6 months ago. Back to you.
Claudia, thank you very much indeed. Banco Sabadell has rejected an offer from the UK's Co-op Bank to buy the Spanish lender's British subsidiary, TSB. Earlier this month, Sky News first reported the £1 billion takeover approach, despite Sabadell's board deciding against a sale last March, following earlier attempts to offload the unit. Still to come then, a wealth tax apparently on the table as Democrats work towards passing President Joe Biden's sweeping spending bill. We'll tell you more about that when we come back.